Howdy, who all my stock market gamblers? I'm Tall Mike, and we have so much to talk about today. What's going on in the stock market? Well, it's Monday, market's back open, right? Having another update, up about 180 on the Dow, up about 150 on the NASDAQ. This has just been a runaway market, straight up, right? Do I think there'll be a pullback at some point? But I do think they're going to push this higher into the end of the year. We're going to close the year on a record high. We'll probably get a pullback along the way. There's still another month left in the year, but this run up, 3 weeks straight, only one down day, 3 weeks straight up, straight up, straight up. Now the 2 weeks before that were straight down, 2 weeks down every day except for one. Okay, so the VIX is at like a 13. 13 on the VIX is really low. That's telling us that there should be a pullback, but this market's been very strong. It's very strong straight up. Now, if you take out the top 7 stocks of the S&P 500, 500 stocks, right? Take out the top 7, that market's down for the year, right? Okay, so S&P's up about 20%, but you take out the top 7 stocks, it's actually down on the year. Very interesting, very interesting. Now the Russell, which is it's a 2000, right? Okay, so 2000, they're not the top stocks, they're the lower ones, right? Mainstream more. But now the Russell, you go back 2 years, that's still down 20%. Go back 2 years on the S&P, it's basically flat, but the Russell is still in this bear market. Now, I do think they're going to push the market higher, but we're overdue for a pullback, right? 3 straight up weeks. It's due to have a little bit of a pullback, but this is a short trading week. We got Thanksgiving, and they can do anything with the market this week. We got NVIDIA coming out with their earnings tomorrow, and that should be a market mover, one direction or the other. We'll see which way they're going to push this market. All right. Let's get over to the real estate market now. Now, a lot of people, they get upset. They actually get very upset when I say the housing market is going to drop by 50%. 50% is what I'm calling. Actually, only 40% from here. It's down about 10% already. But it has another 40% to drop. And people they say, but Mike, there's no inventory out there. Now, the inventory, there is inventory. Do you realize that 10% of homes in the United States are vacant? 10% of homes are just sitting vacant. Do you also realize that 25% of homes, rough number, are owned for investment purposes? Okay. All right. Now, I think these investors are going to be fleeing the market. Now, everybody's telling me, Mike, you're crazy. Investors are going to be buying this market as it comes down. I don't think so. I think they're going to be the ones dumping the properties. Now, can I tell you why? All right. So right now, they want you to look at the stock market. Stock market going up, stock market going to hit record highs. Everything's fine, right? Well, the economy's not doing so well. Look at the credit cards. Okay, credit cards, record high. All right, now what interest rates are they at? They're also a record high. Why would people take out record high debt at record high interest rates? One answer. Desperation. A lot of people are desperate. They don't have money right now. A lot of people are getting to become unemployed. Unemployment is actually spiking up higher. It's up 0.5%. Was about 3.5%, and now it's up around 4%. This tells me we're already in a recession. Now you can believe their numbers. 4.9% on the GDP. Mike, how can we be in a recession? Look, these are government numbers, and if you take away the government spending from those numbers, you will have a negative print on the GDP. The reason the GDP is up is because we're printing at a rate of $4 to $5 trillion a year. $4 to $5 trillion a year is what we're printing right now. Okay, so can we continue at that? We got about $34 trillion in debt, about another $8 trillion on the Fed's balance sheet, and about another $100 trillion in unfunded liabilities. Now, let me ask you a question. Do you think the government is ever going to stop printing money? They're going to keep printing the money, right? They're not going to stop. They can't stop. There's no way they can stop. They are going to keep printing money. There's no politician that's going to come out and tell you we're going to cut Medicare, tell you we're going to cut Social Security benefits. These benefits, there's no money for them. They're unfunded, so they have to fund them, right? And how do they fund them? They fund them with printing money. Okay, so here's what we got. Right now we have $1 trillion. $1 trillion just on interest payments on the 34 trillion that we owe. And this is going to double next year. See, half of the money that's out there is going to roll over. Now, right now it's financed at 0.25%, let's call it, but it's coming due. And it's going to have to be financed at 5 or 6%. It's going to increase that interest payment of $1 trillion each year to $2 trillion a year. And this is going to happen next year. It's going to be $2 trillion. Okay, now we bring in about 4 trillion, right? So take away 50%, 50%. Every dollar you pay in taxes is going to go to and pay just the interest rate, not paying down the debt. That's just the interest on the debt. But they're going to continue to print money because they're going to continue to run the government, continue to pay Social Security, continue to pay Medicare, to continue to pay for 1, 2, maybe 3 wars by then, right? So they're going to continue to print money. All right. So now everybody says that, well, Mike, the Fed's going to pivot, right? They're going to bring down interest rates. Look, at the Fed thinks they control interest rates. And yes, they can bring down the discount rate at the discount window. They can bring that rate down. But what they don't control is the longer end of the curve, the 30-year, the 20-year bonds. These are controlled by what people demand payment for. Now, people are starting to see that when you're paying 50% of all the money coming in, that they don't want to lend us money. They don't want to buy our bonds anymore because we're paying 50% of the tax revenues are going to be going to interest, and that's going to be starting next year. So people are going to see this. Now, are you going to loan the government for 30 years your money at this low rate? No, you're going to demand a higher rate of interest. You're going to demand more payment. You're going to demand 5, 6, 7, 8%. What's that going to do? It's going to push mortgage rates up. But it's also going to send the investor fleeing. Right now, the investor, he got free money. He got free money from the Federal Reserve, right? All these companies like BlackRock and Blackstone, they were getting money at 1%, 1%. Even when you went and bought your house, you had to pay 2.8%, right? But they were getting money at 1%. So they were coming in and buying the houses for cash, and they were buying about 30% of the homes went to the investor. But now they're going to start to see these higher rates, 6, 7, 8% on the long end of the curve, on the long end, the 30-year bonds, the 20-year bonds, where they're looking at what they're getting in the, for rent. A lot of people are going to stop paying rent. Why are they going to stop paying their rent? Well, because they're going to be out of work. They're going to lose their job. They can't pay rent. Landlording is going to become a very difficult business. And once you see the houses start to drift down lower, now Billy Bob got out up here. We're about 10% down, and we're going much lower. Now, of course, your area, you keep going up. You live where the Moon Boys live. And the Moon Boys will tell you that the market's going much higher. But in most areas, over average across the U.S., down about 10%, right? Okay, but it's going to continue to drop. Now, investors see this. They're not going to be buying properties. They're going to be running for the exits. They're going to be the first one out. Remember, they own about 25% of the homes. Those homes are going to be dumped onto the marketplace. Okay, now, did you guys ever really think, like Airbnb, right? A lot of people have 5, 6, 7, 8. Some have 10 properties. Airbnb properties, and they rent them out. Did you guys ever really think it was a really good idea to turn the housing market into a hotel? Now, I never thought that was a great idea. Yeah, it's great for the investor. I can come out and raise the rents because he's getting a daily rent. I see that, but it takes away the housing supply. So a lot of these people in a lot of cities, they're banning the Airbnb. These are going going to be dumped onto the marketplace because they are in trouble. They're financially strapped now. They can't make their mortgage payments because they can't bring in enough money on the rents because the short-term rental has been banned. So the Airbnb properties are going to be going out, right? They're going to be dumping those back onto the marketplace. Okay, so the investor, they're going to be dumping these onto the marketplace. But we got this curve now, or the curve where we keep printing money, right? We're going to get inflation. Everybody thinks inflation's done. No, as long as we keep printing money, inflation's going to come back and it's going to jump well above that 9%, 10, 12, 14%. Right now it's down from 9%. They say it's down 3%. I don't buy it, but prices are still going up. They're not coming down. Prices are not coming down. Prices are still going up, and they're going to be going up much higher as they continue to print money. $4 or $5 trillion a year is being added onto the debt. Nobody's going to want to buy the debt. Now, here's the thing. Nobody's going to want to buy the debt because they keep printing money, so they're going to have to pay 6, 7, 8%. So the government at that point is really going to have two options. Let me tell you what the options are. They could default on the debt and just say, we're not going to pay the debt. Okay, they could do that, right? That's a possibility. Not going to happen. Why? Okay, common sense will tell you that would hurt the rich friends. Rich people own all this debt, right? And rich people want to get paid. So they're going to print the money to pay the rich people. Now, when they print the money, who gets hurt? Well, the poor people get hurt. How do they get hurt? They get hurt with higher prices. Now, the government's much rather hurt the poor people than their rich friends. They don't want to hurt their rich friends. So they're going to print the money. They're going to keep paying all this interest on the debt. They're going to keep paying the Social Security. They're going to keep paying the Medicare. But those payments aren't going to be worth anything. When you get your Social Security check, you'll bring it to the bank and you'll cash it and then you'll go buy groceries. And you'll realize you don't have enough money to pay for groceries to eat for the week, let alone for the month. So that's what is going to happen. Now, look, they're not going to default. You're going to get your money. It's just not going to buy anything. Now, what's this going to do to houses? It's not going to be good. You get mortgage rates above 10%. I think we're going to 10% next year. But Mike, mortgage rates have come down. Just this past week, they dropped mortgage rates from 8% down to 7.6%. You got this all wrong. The Fed's pivoting. The Moon Boys got it right. It's going straight up from here. I don't see it that way. I really don't. I know my views. People call me a contrarian. I just say it's common sense. It's common sense. What's going to happen? Look at prices. Nobody can afford a home here. Why would home prices double? They're not going to double. People cannot afford them here. They're going to come crashing down when mortgage rates get up higher, 10, 12, 14%. It's going to send down. Why are mortgage rates going to go up higher? Because the long end of the curve, which is the 30-year money, is going to be going up because people are going to demand more money once they see the emperor is not wearing any clothes. We cannot pay back our debt. There's no way we can. 50 cents of every tax dollar, this is just starting next year, will be going just to pay the interest on the debt. It's not sustainable. People are going to start to see that, and they're going to start to demand higher and higher prices. We have a very good chance that we'll probably go into some type of hyperinflation, and I think call it, we'll probably get to 40 or 50% inflation a year. Now, hyperinflation by definition is about 50% a month. Now, I pray it doesn't ever get to that level, but we're going to hyperinflate. We're going to keep going up because they're going to continue to print money because that's all they can do. That's their only option left. They have the option to default, but that's not popular. That they can't win with that. They can't default on Social Security. They can't default on Medicare. They can't default on the bonds. They're going to continue to pay those, but they don't have the money to pay it. So what are they going to do? They're going to print the money into oblivion. They're going to kill the dollar. There's going to be a reset. They're going to reset the dollar. It's going to go to a digital dollar, a central bank digital currency. So how would I be protecting myself here? I'd be doing what the central banks are doing. Central banks are buying up gold. They're buying gold hand over fist. I mean, it's really amazing how much the central banks are buying. Just in the last 12 months, they bought 1,200 tons, 1,200 tons of gold. That's a lot, right? I mean, now the U.S., how much gold do we have? Well, they say we have 8,000 tons. 8,000 tons. What's that worth? $2,000 an ounce? That's worth about $500 billion, $500 billion. So we do have some gold when the reset happens. They're probably going to need the gold, and that's why central banks are buying a lot of gold to reestablish the confidence in the currency. Right now, people are losing confidence in the currency. The currency is losing purchasing power. You're going to see the long end of the curve moving upwards in interest rates. Right now, it's about, 5%? I think it can double from there easily. Easily. Yes, everything looks great right now. Look at the stock market. Stock market's doing great. Just keep looking at that. Don't look at the real economy. Don't look at all the money we're printing. We can print enough money to make the stock market go up. We can. Look, I think the stock market's going to come down by 50% also. It's going to see this, that it's not real. Everything's fake. Stock market's fake. House values are fake. Economy's fake. Look, just open up your eyes and look around. You can see it. This is just common sense. This is not a contrarian view. This is a common sense view. It's just my take. I'm Tall Mike. If you like this stuff, give me the thumbs up. I know it's Monday. We got a short week. Thanksgiving week, everybody. Happy Thanksgiving, but come back. I'll probably be on here again Wednesday to talk to you again. Punch that subscribe button. Get out there. Have a great day, everybody. Bye-bye now.